The recent quarterly board meeting concluded, yet the glossy report has left owners uncertain about the true events of the year. While the numbers appear impressive, the language used seems crafted to provide reassurance rather than an accurate depiction of reality. This confusion deepens when managers treat shareholders as outsiders and approach reporting like a marketing opportunity. When incentives highlight headlines, increasing stock prices, and deal-making, transparency and discipline are often sidelined. As a result, owners miscalculate risk, potentially overpay for growth, and accept financial representations that obscure actual economic performance. Over time, a few poor capital decisions can overshadow years of dedication by employees and customers alike. Imagine a company reporting record profits while cash obligations swell, only for owners to uncover the full story later. Meanwhile, directors meet privately with the chief executive, receive optimistic forecasts, and rarely challenge assumptions in their absence. Following this, an effective owner mindset emerges, along with market psychology and the accounting principles essential for sound valuation. This video draws inspiration from The Essays of Warren Buffett by Warren Buffett. Be sure to subscribe for additional owner-focused insights. An owner-oriented approach treats managers as stewards, ensuring they manage shareholder capital with the diligence expected of long-term owners. This approach succeeds when reporting utilizes straightforward language and comprehensive numbers, prioritizing intelligence over financial manipulation. Clear disclosures minimize surprises, empowering owners to assess debt, obligations, and reinvestment needs before challenges arise. Furthermore, this fosters trust, as both good and bad news are presented together rather than separated by spin. A shareholder letter that openly discusses mistakes, limitations, and key assumptions enables owners to evaluate decisions without sifting through footnotes. Conversely, a report relying on adjusted metrics and overly optimistic forecasts forces owners to make educated guesses about what management is withholding. This strategy treats a corporation as a partnership, where informed owners and forthright managers operate on the same set of metrics. When the metrics are transparent, the focus shifts to capital allocation rather than the public relations narrative of the quarter. Assess whether disclosures clarify the factors influencing intrinsic value, including reinvestment rates, owner earnings, and primary risk sources. Support managers who communicate clearly, acknowledge uncertainties, and ensure that every shareholder has access to the same information. Effective governance begins when directors act as owners rather than merely ceremonial guests approving management proposals. This system requires independence, such as regular meetings without the chief executive, and a readiness to question projections. When boards falter, compensation systems may reward size, leverage, and acquisitions even as owner value diminishes. Inadequate incentives can also lead to questionable accounting practices, where reported results become the quickest route to bonuses and reputation. Picture a board that only meets with the chief executive, repeating a flattering narrative in the annual report. Contrast this with directors who engage with top managers independently, assess succession plans, and view errors as opportunities to take action. The owner mindset translates from investment to oversight, as the same capital needs safeguarding within the business. If leadership cannot be relied upon for honesty, even a strong product line might lead to a poor, long-term investment. Consider executive pay as a strategic decision similar to how capital is allocated, and evaluate it against owner returns and long-term value creation. Seek boards that prioritize transparent reporting, challenge unnecessary expansion, and take decisive action against leaders who justify persistent underperformance. Market quotes often reflect sentiment as much as actual business value, so price movements alone shouldn't dictate perceptions of risk or opportunity. Mr. Market serves as a metaphor for this sentiment, presenting prices daily that can swing from excitement to despair. When investment decisions are swayed by these fluctuations, investors tend to buy high and sell low, relinquishing control over their timing. A margin of safety means acquiring shares at a price below a reliable assessment of value, allowing room for unforeseen circumstances. In times of market turmoil, share prices may plummet even if the underlying business continues to generate steady earnings. During market booms, a favoured stock can soar far beyond owner earnings, luring in buyers who rely on continuing positive sentiment. Owner-minded investing centres on a business's output rather than what others might pay tomorrow. This approach also acknowledges a circle of competence, ensuring decisions are made within areas that can be comprehensively understood and monitored. Clearly outline what must be true for value to grow, and remain focused while disregarding short-term market noise that contradicts foundational principles. If this mindset fosters calm decision-making, embrace it and develop enduring judgment regarding price and value. Capital allocation determines whether profits enhance future earning power or devolve into expensive initiatives and wasted efforts. The choice lies in deciding between reinvesting profits, distributing dividends, buying back shares, or pursuing acquisitions based on anticipated value. Each dollar retained should generate at least $1 of market value over time. Otherwise, owners are not receiving fair value. Frictional costs such as commissions, spreads, and taxes can quietly erode returns, so frequent trading can diminish gains, even when trades are correct. When a company buys back shares above intrinsic value, it essentially exchanges $1 of business for less than $1. Conversely, when shares are repurchased below intrinsic value, the value of each remaining share increases its claim on future owner earnings. These capital allocation decisions embody the same owner-focused mentality, as owners prioritize per-share value over corporate activity. Even an astute investing strategy can falter if the business itself mismanages reinvestments or issues new stock carelessly. Monitor how earnings are utilized each year, and evaluate the returns from retained funds against those from distributed funds. Opt for plans that minimize hidden costs, utilize share repurchases judiciously, and maintain consistency in decision-making over the years. Valuation begins with understanding intrinsic value, which is the discounted value of cash that can be extracted throughout a business's lifetime. Owner earnings provide this cash estimate by adjusting reported earnings for necessary capital expenditures, working capital, and competitive positioning. Relying solely on accounting earnings can be misleading, as maintenance expenses may consume a large portion of the cash generated. If complex financial instruments are valued based on models, reported profits can appear without actual cash flow or manageable risk. While a purchase price may include goodwill, true economic goodwill hinges on lasting customer behaviours rather than mere accounting frameworks. A derivatives portfolio can demonstrate paper gains for years, only to unexpectedly require collateral and instigate a liquidity crisis. These tools empower an ownership mindset by distinguishing real earning power from figures that may be influenced by incentives. They focus our attention on businesses that are straightforward, as complexity often conceals both costs and relationships. Assess intrinsic value using cautious assumptions, then compare it to the market price, and ensure a clear margin of safety before making a purchase. Scrutinize accounting notes for cash obligations and hidden risks, and treat any unexplained complexity as a caution sign. The fundamental shift is to approach investing as a partial owner, whether you're evaluating a stock, a board, or a set of financial statements. This perspective replaces excitement with evidence and regards every decision as a strategic allocation of limited resources and trust. Transparent disclosures and solid governance align the interests of managers and owners, reducing the likelihood of unexpected surprises. Market discipline is achieved by wisely engaging with Mr. Market, staying within your expertise, and insisting on a safety margin. Over time, minor advantages in valuation, cost management, and capital allocation lead to significant differences in outcomes for owners. The true reward lies not in frequent trading, but in the confidence that your decisions are based on cash flow, behaviour, and rational motivations. Start by reading a company's annual report for clear communication, and be mindful of any terms that obscure leverage or risks. Create a straightforward checklist for valuation, governance, and capital utilisation, and refer to it before making major decisions. With a consistent checklist, market fluctuations become less distracting, allowing you to view the corporation as a partnership worth investing in. If this owner-first approach resonates with you, consider subscribing for more actionable insights into reading businesses, prices, and reports clearly.